Okay, good morning, students. Today is the third day, and we are doing the course Advanced Financial Management. On this course, we are actually touching the topic foreign exchange exposure and risk management. So far, we have covered most of the basics in this subject. Today, we are going to go further and understand more important concepts. Now, today, the focus would be basically on the foreign currency exposure risk. And also, we'll be doing some question and understanding about the forward markets and the forward rates, okay, whenever the company takes forward contract. So good morning to you all. I can see a lot of students, Viraj, Tanisha, Shruti, Kirti, and Manisha. Good morning. So foreign exchange exposure risk. Now, first of all, though we have covered this, so I'm just revising. So who are the market participants? We know that the banks are they are the market participants. They are present into the foreign exchange markets. They exchange currencies as per the requirements of their clients. And then we have the non-banking entities, which are basically all the multinational companies which exchange currencies to meet their import or export commitments or to hedge their transaction. And today we are going to focus on how do we hedge our transaction, either using the forward cover or futures through the stock exchange or through options. So that we'll be covering today and tomorrow and day after. And then there are third kind of participants who are called speculators. Those people, they don't have any underlying position, but they speculate in the currency movement. If they think the dollar is going to appreciate in next 1 month, so they're going to take a long position. And if they think the dollar is going to, depreciate, so they're going to take a short position. So for any currency, they can do like that. And they make money without having any position whatsoever. Neither they are exporters nor they are importers, but they speculate. Now, the fourth category is arbitrageurs, which we have done yesterday a lot about. So they make profit from the price differential between the forward market and the spot rates. Now, government also is a participant. Government acts through the Central Bank of India, like, we have Reserve Bank of India in India, and, we have the Federal Bank in US, and all countries have their central banks. So they basically, the job of the RBI in India is basically to stabilize the exchange rates. So they don't want the exchange rates to go up and down so much so that it can impact the economy and the corporate world. Now, let's understand that, if you're an exporter who sells his product in the foreign currency, has a risk that if the value of the foreign currency falls, then the revenue in the exporter's home currency will be lower. For example, if you're an exporter and you have sent goods outside, at the time when you sold your goods, the dollar rate was 83, and when you got actually the money from abroad, the rate was 81. So that means you suffer a loss of 2 rupees. Okay, so that means exporter is also having a risk. Similarly, an importer also who buys goods priced in foreign currency has the risk that the foreign currency will appreciate, thereby making the local currency cost greater than expected. For example, at the time when an importer, imported goods, the rate was 83, but then when he was supposed to make a payment after some time, maybe after a month, after 2 months, depending on the credit terms, then he finds the rate has gone up to 85. So he will be suffering a loss of 2 rupees. Okay, so these are the risks which are there in the foreign currency exposures. So fund managers, basically people who invest money on behalf of others and companies who own foreign assets. Now, whether you're a fund manager or you're a company, and if you own foreign assets, they are exposed to foreign currencies where they own the assets. Now, suppose an Indian company is owning an asset in America. So he may, if the dollar appreciates, so the assets will also appreciate. But if the dollar depreciates, their assets will also diminish in their value. So now let's understand that there are 3 kinds of exposures which, anybody has to face. First is called the translation exposure. The second one is called the operating exposure. And finally, the one is called the transaction exposure. So translation exposure is nothing but a balance sheet exposure. When we are making a balance sheet, at the time when we make balance sheet, we take always the current rates. Okay. So basically, companies' equities, assets, liabilities, or income will change in value as a result of exchange rate changes. Whenever we are making a balance sheet, a consolidated balance sheet, we have a, either a holding company or subsidiary company abroad. So we consolidate and we convert the values into the say home currency because of the subsidiaries in a foreign country. So it can change the position of assets and liabilities. Then we have the operating exposure, which is also called the economic exposure. So we'll understand what is the operating exposure. And then, finally, we have the transaction exposure. So transaction exposure is basically, when we enter into the transaction and when we are actually, making a payment or receiving the payment, if there are differences, we can either suffer a loss or gain. So let's understand the transaction exposure in more detail. So it's the risk that the currency exchange rate will fluctuate after the firm has already undertaken a financial obligation. So it's a risk that the currency exchange rate will fluctuate after the firm has already undertaken a financial obligation. For example, if an exporter has a receivable of, say, $1 lakh due in 6 months, hence, if the dollar depreciates relative to rupee, a cash loss occurs. Okay, the dollar comes from 83 to 81, so he will be suffering a cash loss. Conversely, if the dollar appreciates relative to the rupee, cash gain occurs. So, this is called the transaction exposure. So now, we'll be looking at a question, okay, and I'll be solving this question both on board and showing you my notes here, okay. So there's a company called Omega. Now, this is a question which came in, your CA final exam, but I have changed a bit to make it, because the rates were quite old, so I have, made the new rates, which are, prevalent now. So Omega Electronic Limited exports air conditioners to Germany. So there's an Indian company which is, exporting air conditioners to Germany by importing all the components from Singapore. That means they are buying goods, the raw material and components from Singapore, but their customers are in Germany. The company is exporting 2,400 units at a price of euro 500 per unit. Okay, so that means they are, when they are selling goods in Germany, the selling price per unit is 500 and they are selling 2,400 units. The cost of imported components is Singapore $650. So the cost is $650 per Singapore dollar. The fixed cost and other variable costs per unit are rupees 1,000 and rupees 1,500 respectively. So fixed cost is 1,000 and variable cost is 1,500 per unit. The cash flows in foreign currencies are due in 6 months. Okay, that means they are going to incur all the cost, which is in nature of either receiving money from the Germany or making payment to Singapore in terms of Singapore dollar. This is going to happen after 6 months. Okay, the exchange rates are as follows. So this is the exchange rate. This is the spot exchange rate. Okay, the current exchange rate, which is where the rupee euro is 89.50, which is the bid rate, and 89.55, which is the ask rate. And similarly, rupee Singapore dollar is 61.20 and 61.25. So this was the rate at the time when he made the exports. So when he's selling goods abroad in euros, so that means he's going to get his money. Okay, so he has to look for the bid rate here, rupee to dollar. Similarly, rupee to Singapore dollar, since he's going to spend money, he will be looking at the ask rate for making the payment. Okay, so just to tell you that. So after 6 months, now of course the spot rates are not so relevant. It's basically to find out what is the kind of loss or gain he has suffered because of the currency rates changes. Now after 6 months, the rates turn out to be 91/91.05. That means the euro has appreciated against the rupee. Okay, so the rates have come to 91 to 91.05. So this is per 1 euro is equal to so many rupees. Then the Singapore rate has gone up to from 60. It is after 6 months it is 62 rupees 70 paisa and 62.75 paisa. So bid and ask, both the rates are given. So you are required to calculate the loss gain due to transaction exposure. Okay, so these are the information which are given to you. The rates, the current rates are given, and the rates after 6 months are given. Okay, so we'll find out how much either has the company Omega suffered a gain or loss due to transaction exposure. So this again, I put this question like this. So same thing. Okay. So he exports air conditioners to Germany by importing all the components from Singapore, and the rate of selling price is euro 500, and the components that are imported at Singapore $50, and the fixed cost and variable cost are also given. Cash flows in foreign currencies are due in 6 months. So this is the rate, the spot rates, and these are the spot rates after 6 months. So same question has been again put in a manner so that you can see it properly. Okay. So then we have, you're required to calculate the loss gain due to transaction exposure. Okay. Now I'll just, rise up and go to the board. But before I do, I'll just show you this, and then we will, solve this on the board also. Okay. So I'm just going to show you. Now, look at, at the time when he, exported goods to Germany, these are the profit at the current spot rates. Now, the sale is 2,400 units, we know, and the selling price is 500 euros. The exchange rate, so we have to look at the bid rate. Why? Because, bid is meant for exporters and ask is meant for importers. When we are, buying a currency, we buy at the ask rate. When we are, selling, when we receive money from abroad and we go to the bank, so bank will give us a rate, with the relevant rate for us will be bid rate. But as an importer, it will be the ask rate. So profit, now that sale will now go to, that means it is 10 crore 74 lakhs. So we multiplied 500 into 89.5. So we got this thing. Now look at this. This is the quotation which was given to you. 89.50 was a bid rate and 89.55 was the ask rate. So we chose to apply the bid rate here. Okay, because this is an export transaction, and he is going to surrender the euros and convert them into Indian rupees. So he's going to go to the bank, and bank is going to convert his euros into Indian rupees at the bid rate. Then the cost, as we know, the Singapore dollar is, the cost is 650 per unit, and the total number of units are 2,400. So here we are going to look at the ask rate, because now he's importing. Okay. So the cost, the rate is given 61.20 and 61.25. So which means 61.25 will be relevant rate. So the cost of the Singapore dollar will be 61.25 multiplied by 650 multiplied by 2,500. So we get 9 crore 55 lakhs 50,000. So now we know the variable cost and the fixed cost. Okay, that is in Indian rupees. That is not going to change. So this is 2,400 units multiplied by 2,500, which is 1,000 rupees variable cost and 1,500 fixed cost. So the total cost in terms of Indian rupees will be 60 lakh rupees. So which means that his total cost would be the cost of components, which is 9 crore 55 lakh 50,000, plus the variable and fixed cost, which is 60 lakhs. So which would mean the total cost will be 10 crore 15 lakh 50,000. Now he has sold the goods at 10 crore 74 lakhs. His cost is 10 crore 15 lakh 50,000. So he makes a profit of 58 lakhs 50,000. Okay. So now I'm just going to stop here and going to the board to cover the second part of my question. Okay. So let me know if you can hear my voice clearly and you can see the board. So now what we are going to calculate is profit. So we calculated the profit at the spot rates. Now we are going to calculate the profit at or after 6 months. Okay. 6 months spot rates. So after 6 months, what was the spot rate? We are going to use that. So first we calculated the profit as per spot rates, which is the current rates. So that profit, we can just note it down. What we calculated was, 58 lakhs. It was rupees 58 lakhs, 50,000. Okay. So this was the profit at the current rates. Okay. Fine. Now we are trying to calculate the profit at the spot rates. 6 months spot rate. So first is sales. Okay. And we know the units are 2,400. So this is units. Okay. Then the selling price is in euro. Okay. And we know it is euro 500. Okay. So this is the price which is there. Okay. Then we look at the bid price. So the bid price which is given as 91. Okay. So if you remember, the price was 91 oblique 9105. So this was given. Okay. Just going to the stop. So rather I'm going to write the bid price. You all know that. So it is 91. Okay. So this was the bid price. Okay. Fine. So we multiplied the bid price, this into this, and calculated what was the sale. The sales comes to 10 crore 92 lakhs 00 0 0 0. Okay. Fine. So this is basically in rupee. Then we come to the cost. Now the cost is basically the components which he has imported from Singapore. Okay. So we can say components. So 2,400 units multiplied by Singapore dollars, 650, multiplied by the ask rate. Here we are going to take the ask rate. Okay, which is 62.75. So 1 Singapore dollar is equal to rupees 62, and here also it was rupees. Okay. So if we multiply this, we get the total cost as 9 crore 78 lakhs 90,000. Okay. Fine. And the cost, the fixed cost, the cost which is incurring in India, fixed cost plus the variable cost. Okay, which is on 2,400 unit, the fixed cost and variable cost is given as basically 1,000 rupees and 1,500. Okay, fine. The fixed cost is 1,000 and the variable cost is 1,500. So altogether the cost will be 2,500. So we multiply this, okay, and get the total cost, which is 60 lakhs. Okay. Then we arrive at the total cost. Okay. So the total cost would be 10 crores. So this plus this would be 10 crore 38 lakhs 90,000. Fine. So if we take this figure and this figure and calculate his profit, so which is coming down to 53 lakhs 10,000. Okay. So the profit, when he gets, finally his profit is 53 lakhs. At the time when he exported, or when he was, exporting his goods abroad, the profit was 58 lakhs 50,000, and now it is 53 lakh 10,000. So that means there is a loss now because of transaction exposure, which is 58 lakh 50,000 minus 53 lakhs 10,000. So which means he has suffered a loss of 5 lakh 14,000. So this is his loss, transaction loss. Okay. So I'm now going to back to the board. Okay. Have you all followed? So please let me know. So I'm just going back to the screen and going to show you the so let me just correct. So I'm just getting this thing. So I'm just removing this screen. Yeah. So what has happened was, if you go and see, this was his profit at the current spot rates. Okay. The euro was 89.50. Okay. At the time when he did the transaction, and when he finally it became 91 lakh this thing. So though the revenue got increased, because the euro has appreciated, so it has positively impacted his business, but the cost in terms of Singapore, his component cost, which was 61.25, the ask rate, that has gone up to 62.75. So on the component fronts, he has lost money. So he was spending 9 crore 55 lakhs 50,000, and now he's spending 9 crore 78 lakhs. Okay, so that's a difference. So he has made a positive impact. He has got a positive transaction exposure as far as his sales are concerned, but he has suffered a loss because his component cost has gone up significantly. Okay, it has gone up from 61 to 62.75. So now he's incurring a good amount of cost in importing components. So that's why he has suffered a transaction exposure. He made a profit of 53 lakh 10,000. At the time when he exported, his profit was coming out to 58 lakh 50,000. So which means that he has suffered a loss, because of the transaction exposure. Because he got his money, or whatever money he paid on his imports, they all happened after 6 months. And by the time the euro has appreciated, which brought a positive impact to his business, whereas the Singapore dollar brought a negative impact because that was a cost to him, and Singapore dollar has actually appreciated against the Indian rupees, which means that he is going to spend more in terms of Indian rupees as far as his component cost is concerned. So overall, the transaction exposure is negative, which is 5 lakh 40. I hope you have all understood. So please, if you have, please let me know and tell me if you were able to see whatever writing on the board and my voice was okay. So then I can continue with that. Because otherwise, I will be on the slides. Okay. So this was the question which came in the CA final. Okay, where the rates were were quite old ones. So that's why I have changed it. So I'm just going to the second one. So this is I've already covered. Okay, so now we go to, okay, please give your replies. Was it clear? There's any doubt? Should I explain it again, or should I move forward? So I'll just wait for a response, but in the meantime, I'll move forward. Now we come to translation exposure. Now, this is a risk that the organization will make. Is my board visible now? I mean, my slides are visible. Okay, so translation exposure. So this is the risk that the organization will make exchange losses when the accounting results of its foreign branches or subsidiaries are translated into home currency. Okay. So Kumari Jyoti, you understood very good. So got it. Tanasha, what about you, Shruti? Okay. Please summarize. Namrata, I have already summarized. So what I said was, that in this case, what had happened was, without even referring to the slide, I can say that, when he was, we are trying to calculate what was his transaction exposure. Okay. So we come back to the transaction exposure and go to the final slides. Okay. So go to the slide where, we did the question. So this was the question. So I'm just, briefly, I'm going to, summarize. So, at the time when he, got, the actual transactions, all transactions occurred after 6 months. That means he got his money after 6 months and he paid for his component also after 6 months. At the time when he, was getting the order from abroad, and by the time he actually got his money, so the exchange rates have moved. Okay. Now the euros have appreciated, so which is going to have a positive impact on his, rupee realization, because that the rate has gone up from say 89 to 91, so he has gained. Okay, so we can just see that in our earlier the rate was 89.50 and now the rate is 91. So in terms of sales, he has made money. The transaction exposure has actually positively impacted his business. But with respect to cost, which is the cost of component, because he's importing, some components from Singapore dollar. So the rate of Singapore dollar now is 62.75. Earlier, it was 61.25. So this is going to have an adverse impact on his business because he's going to pay more money in terms of Singapore. So now he's paying 9 crore 78 lakhs 90,000. Earlier he was paying 9 crore 55 lakhs. So which means, so he's positively impacted as far as sales are concerned, but he's negatively impacted as far as his cost, imported component cost is concerned, because he's importing from Singapore dollar. Singapore dollar has appreciated, so which means he has to pay more. Okay, his cost will go up. Now the variable cost and fixed cost remain same, which is 60 lakhs in both the cases. So we will calculate the profit. We found that his profit has now 53 lakh 10,000. At the time when he got the orders and everything, that time he was making a profit of 58 lakh 20,000. So he calculated this will be his profit. Okay, on if he carries out this business. But when he carried out his business and actually when he received the money, he got only profit of 53 lakh 10,000, which means that he has lost 5 lakh 40,000 because of the transaction exposure. Okay. Now let's go to the second part and understand what is a translation exposure. And I hope you have followed, Namrata. Have you? I mean, you said please summarize. It's okay. Okay. So let's move forward. So let's come to the translation exposure. So this is a risk that the organization will make exchange losses when the accounting results of its foreign branches or subsidiaries are translated into home currency. So every year at the time of 31st of March, we make our balance sheets. Companies which have subsidiaries, they consolidate their, holding and subsidiary accounts and present them to the shareholders. And, the subsidiary company can be a foreign subsidiary or even, a company which is abroad who's subsidiary in India. So they're going to make a consolidated accounts and convert all the assets and liability into the home currency. Suppose it's an Indian company which has a foreign subsidiary. So they are going to convert all the foreign subsidiary assets and liabilities in terms of Indian rupees at the time, the exchange rate on 31st of March 2000. Okay, or 24, like for example. Now, translation exposure is also called accounting exposure. Okay, so it is accounting exposure. Typical example of translation exposure is treatment of foreign currency loans. When you take a loan, from abroad at a certain rate, suppose you're taking a loan in terms of dollars, and dollars was 83 rupees at the time, and you took 1 lakh, suppose 1 lakh rupees, $1 lakh loan. Now, say after, at the time of closing your accounts on 31st of March, you found the rate has become 83.50. So that means your loan liability will go up in your balance sheet as against at the time when you actually took the loan, it was 83 rupees per dollar. Now it is at 83 rupees 0.50 at the time when you're making a balance sheet. So let's take another example. For example, a German subsidiary of an American company, there is a German subsidiary of an American company. So American company is a holding company and German company is a subsidiary. Purchases a building worth 1 lakh euros on October 1st, 2022. On this date, the euro dollar exchange rate was 1 euro was equal to $1.15. So that the value of the building converted into dollar was 1,15,000. So for the American guy, the cost was $1,15,000 because, €1 was equal to $1.15. Now, the company decides to convert all its foreign holdings into dollars to present a consolidated balance sheet as on 31st of December 2023. On that date, the exchange rate changes to €1 is equal to $1.01. So that the value of the building will fall to $108,000 in the balance sheet. So, at the time when they, bought the asset, it was valued at $115,000. At the time when they're making the balance sheet, they found that the value of the building has gone down to because of the exchange rate change. Okay. So this is called the translation exposure. Now, finally, we have the economic exposure. This refers to the effect of movement of exchange rates. Of course, it is because of the movement of the exchange rate on the international competitiveness of the company, Now, companies, there are multinational companies, there are Indian companies who are also trading abroad and doing business abroad. So it is going to have an impact on the international competitiveness of the company. For example, a company like TCS or Infosys who are exporting their goods mainly to US and Europe. And if the dollar appreciates, so they make more profit. The revenue in dollar terms goes up. Okay, so their competitiveness goes up. But if the dollar depreciates, then they're going to lose out in terms of profitability, and also their competitiveness also goes down. So let's talk about economic exposure is the term used to define the risk posed by foreign exchange rate fluctuations with adverse effect on the company's financial stability. So this is an exposure which is going to cause an adverse impact on the financial stability of the company. Okay. For example, let's try to understand that an Indian company uses raw material which are priced in US dollars, but exports its products mainly to European Union. So that means all the cost is in form of US dollars, all the revenue which are coming are in terms of euros, okay, because they're exporting their products to European Union. Now, a depreciation of rupee against the dollar or appreciation of rupee against the euro currencies will both erode the competitiveness of the company. Okay, a depreciation of rupee means an appreciation of the dollar. So your raw material are in dollar, and if the dollar appreciates, your raw material cost will go up. But it will be other way around. If suppose your money is coming from European Union in terms of euro, so if the rupee appreciates or if the euro depreciates, it is going to reduce your revenue. Okay, so depreciation of rupee against dollar will make raw material costlier, and appreciation of rupee against EU or euro will reduce the revenue. Okay, so this is the impact which it causes. So let's understand through this diagram. So what is an exposure, economic exposure? So, the first on the left-hand side, you have economic, exchange rate fluctuation movement, which are happening. So it is going to impact the assets and liabilities of the companies as well as the operating income of the company. It can adversely impact the company or it can have a positive impact on the company. For example, like company like Infosys or, all the IT companies, if the dollar appreciates, so their, operating cash flows improve. But if it happens other way around, if the dollar depreciates, their future operating profits are going to fall. Okay. Now, again, at the same time, this can also hit the home country currency values of assets and liabilities. The assets and liabilities also fluctuate because of the exchange rate fluctuation. So both will have an impact, both the assets and liabilities as well as, the future operating cash flows will going to affect the value of the company. Now, how do we calculate the value of the company? Basically is, and particularly when we talk about the value of the company, it is basically the market cap of the company plus the market value of the debt. We all know that when we do the valuation concept. Okay. Now, if you are calculating the intrinsic value of the company, first you calculate what is the operating cash the company is going to generate, and then we discount these cash flows using by discounting them with the weighted cost of capital, that is the WACC. So if the future operating profits are going up because of the favorable movement of the currency, So your cash flows will go up. And when you discount them, your value of the company will go up. But other way around, if your future operating cash flows are adversely impacted because of the foreign currency fluctuations, then you will have, it will result in lower value of the company. And then if the value of the company falls, that means the share prices have gone down for the company. So all companies, they want, their motive is that the value of the company should go up. Okay. In today, of course, we have the Reliance industry, which is having the maximum market cap, okay, which is close to about 20 lakh crore dollars. Okay. So all companies would like to improve their value of the company by maximizing their operating cash flows and adopting strategies which does not impact their cash flows by hedging their positions or leaving it unhedged if they think that is going to bring them a better result. Okay, so this finishes the topic of the exposure. So now we will go to the next one. So I go to now we go to the main chapter. Okay, fine. That is basically hedging the exposure risk. Okay, so we are going to do that. So I'm just going to share the slide. So now we are reached to the area where we will be doing the most important questions of forwards, futures, and options. So we begin our journey in that direction. So we're talking about, hedging currency risk. So this is basically the main topic, what we are going to do. So let me just set everything right before I can start. So hedging currency risk. I hope everything is visible. Now, hedging currency risk is a way for a company to minimize or eliminate foreign exchange risk. So now we have started, learning something which is, going to be very important for all your exams, which are going to be there in your CA final, which are, many question comes on, how to hedge the currency risk. Okay, so this is the most important part of our learning. So let's just focus on that. So there are, two techniques through which we, do our hedging. One is called the internal techniques within the business itself, and second is external techniques involve dealing with a third party. So that means you can you can manage your currency risk in two ways. First is internal techniques without involving anyone. You can do it with your business through your business strategy itself. And the second one is, taking the help of either a stock exchange or a bank to take your cover against, your exposures. So involving a third party. Okay. So Mansha is saying one thing: internalization of rupee can reduce the economic exposure. Yeah, definitely. I mean, of course, the government is always doing all kinds of things to see that most of the transactions that happen because most of the trade today is happening in dollar terms, and dollar is international currency. So if rupee gains, it's important, then of course it is going to impact the Indian companies positively. So let's understand now internal techniques. The first internal technique is called leading and lagging. Now, leading means advancing a payment. That is making a payment before it is due. And lagging involves postponing a payment. That is delaying the payment beyond its due date. Okay. So let's take an example. For example, X Limited imports 1 lakh goods from abroad. Okay. And the current rate is, $1 is equal to 82. And the money is payable after 6 months. Now, X Limited expects the dollar to appreciate significantly in next 6 months. So he plans to pay the amount upfront. Now, there are ways and mechanisms basically to forecast the rates, which I may cover a little bit, maybe in the next lecture. So now the company has forecasted that the dollar is going to appreciate in the next 6 months. So since it's an import, so he's going to suffer So he plans to pay the amount upfront so that he will not suffer the loss because of the dollar appreciating. So of course, there was an external technique by which you can take a forward cover. But if you think that you can make the payment early and save a lot of money because of the dollar, you expect the dollar to go to, say, for example, 85, 86. So it's going to adversely impact a lot. So you would like to make the payment. The supplier would be very happy to receive payment earlier. So nobody is going to object, and you make the payment and reduce your exposure in dollars because you expect the dollar to significantly appreciate compared to the rupee. The second one is basically for example, Indian firm which is due to receive payments from its customers in UK may press for a prompt payment from the customer if it expects the pound or GBP rate to fall in future. For example, at the time of exports, the pound was 102, and he expects the pound to depreciate to 95 rupees in coming months. So then, if he gets the money at 95, he's going to get less money per pound. But at the current period, the rate is 102. So he will ask the customer if he can make the payment by offering him some discount or something. Still he gets good money. I mean, he doesn't suffer a loss on account of how much of a discount. But if the customer accepts his plea, then he is going to make the payment earlier. Of course, you have to give some kind of a incentive to the customer to make the payment earlier, so that you don't suffer a huge loss on account of foreign currency fluctuation. Because here we're finding the foreign currency is fluctuating from 102 to 95. We expect the pound to depreciate to 95. Okay. If expectation goes wrong, then there will be make a loss. Yes, Narada, you're right. After all, you can't predict what is going to happen. So, but what happens is the predictions are, always you can make some kind of predictions for a very short period of time. And generally, the hit rate is about 80 to 90%. Okay, based on some technical factors, when you see the movement of dollar versus rupee or pound versus rupee and see the charts and assess that what is the short-term direction of the rupee versus dollar or rupee versus pound. And based on that, you can always take a decision. Okay, but for a very long period of time, the assessment can go wrong, because in short term, you can always make some kind of a better assessment what is going to happen next month or next to next month. So there is something called technical analysis, which you might have started in your, stock market, kind of a paper or future and options of stock market. When this happens, we say that the Indian firm is leading its receivable. So here, basically, it is called leading his receivables. Okay. Now, invoicing in domestic currency. So another technique is called invoicing in domestic currency, because you are invoicing in a foreign currency. Okay. So because the foreign currency fluctuates, you either suffer a loss or you make a gain. So you can just altogether avoid that by invoicing in a domestic currency. Now, invoicing in domestic currency, your suppliers, your customers may not like it. Okay, because they would like to have their invoice in their own currency. Okay, so let's first understand this. Invoicing in domestic currency, an exporter can shift transaction risk to his customer abroad. For example, X Limited invoices rupees 82,000 for their exports. At the time of export, the dollar was 82. Okay, so X Limited has actually raised a bill of rupees 82,000, not in terms of dollars or in terms of euros or pound. He has sent a bill to a foreigner for rupees 82,000 for their exports. So at the time, the dollar was 82. The payment receivable after 6 months. Now after 6 months, the rate of the dollar is 80 bucks. $1 is 80. Now X will still receive 82,000 because he's not impacted of the dollar movement, because he has shifted the risk on the exporter. So importer has to pay $1,025 as against 1,000. See, at the time when he, the order was placed, that time the cost was $1,000, because 82,000 divided by 1,000. Okay, and now it is 1,025. So 82,000 divided by 80. Okay, it gives you a dollar cost as 1,025. Okay, so actually the importer now is paying bearing that cost of extra $25. So when you are actually, invoicing in rupee terms, you're trying to shift your exposure to someone else, and he happens to be your customer, importer. Okay, so he's going to suffer the loss. So, but normally it's a very difficult thing that you invoice your goods in rupee terms, because no customers or suppliers would like that. But recently the RBI has announced that you can invoice in Indian rupees. Particularly today, we are actually invoicing for all our dealing trade with Russia and some countries which are facing some economic embargo. So there, they can't transact in dollars. So the Indian government, RBI, has come with a circular that for certain countries, you can raise your invoices in rupees and receive the money in rupees from abroad. Okay. So in this case, basically, you're shifting your responsibility to someone else. Then we are called netting the exposure. Netting is method of hedging currency risk by offsetting the exposure in one currency with an exposure in the same or another currency. So what is netting? Exposure netting is a method of hedging currency risk by offsetting the exposure in one currency with exposure in the same or another currency. Let's understand this through the example. Suppose X Limited owes $1 lakh to its group company X USA Limited for goods supplied, and at the same time, X USA Limited also owes $80,000 for the services provided to X India. So now company X has to receive money and from company X USA, and similarly X USA also have to receive 80,000. So this will get knocked out, and netting can be done, and only the resultant money, which is $20,000, is basically you have an exposure risk on that, and you avoid the risk by netting off and do the transaction only to the extent of the net balance. Now, it can be in another currency also. For example, X Limited owes $1 lakh to its group company X UK Limited for the goods supplied, and X UK Limited also owes £78,000 for the services provided to X Limited. So at the time when this transaction was done, or this transaction was supposed to be settled, $1 was 0.78. So that means that the complete set off of $1 lakh means 78,000. So no transaction, nothing has to be paid, nothing has to be received, because 1 lakh company X has to receive, but they have to at the same time pay £78,000, which is nothing but $1 lakh, because the $1 rate is 0.78. So this can be completely settled. So then the last one, sir. So I got a question, Satish Kumar. Yes, sir. Invoicing in home currency shifts the foreign risk to the foreign customer. Absolutely right. Absolutely right. You got it. Now, price variation. Price variation involves increasing selling prices to counter the adverse impact of exchange rates. Now, again, this technique is an internal technique, but how far you can do it, it all depends. Okay, because today we have a competitive world, and it is very difficult to increase the selling prices. If the company expects a pound to strengthen against the currency of the overseas customer, it may raise the contract price. So if you expect the dollar is going to strengthen, okay, so you charge more to your foreign customer. Okay, if you can do so, you can avoid the foreign currency risk. But normally, it's very difficult because of the competitive world. You can't charge more to your customers, isn't it? But in some times, if you are a monopoly, you have a monopoly on your monopoly manufacturer, so you can do it. Okay, so this is only under certain circumstances. So now we're going to do some practice questions. Okay, so let's talk about some questions. These questions are all coming from your CA final study materials. Okay, following are the details of cash flows and outflows in foreign currency. This is an example. So we'll be doing some practice questions later on. So this is just an example. Following are the details of, this example is coming from your study material itself. Following are the details of cash flows and inflows in foreign currency denomination of MNP company, an Indian export firm which have no foreign subsidiaries. So these are the detail of cash inflows and outflows in foreign currency of a company called MNP, who is an Indian export firm which has no foreign subsidies. Now, what I have done is that this chart which is coming has just changed because, a little bit in terms of the spot rate and forward rate, which was there in the study material, and made them absolutely recent because the spot rate of dollar was taken, I think, somewhere 60, 65. So what I have done is I've changed them to the current rate to look at more appropriate and better. So US dollar first. So he is basically a company which has, doing business with US, in US dollar, French francs, UK pound, and Japanese yen. So he's actually, supplying goods to 4 countries: USA, France, UK, and Japan. Now he expects to receive this much of money. Okay. This is all in terms of the dollars. First one, the first line is in terms of dollars. So he's going to, he's going to receive, 4 crore dollars, okay, or maybe $40 million, and outflow will be 2 crore dollars. So he has, exported as well as imported certain goods in US. So on account of all his exports, he is going to receive 4 crore dollars. On account of all his imports, he is going to, pay 2 crore dollars. Now, the spot rate at the time when, the transactions happened, it was 83 rupees 1 paisa. The forward rate is 83.82. Okay. Now, for French francs, the inflow was 2 crore, French francs. So this inflow is coming on account of exports to France, and outflow is in account of imports to France, which is 80 lakhs. And the spot rate was 13.45, and the forward rate is 13.1. So then the third one, UK. So his total exports were 3 crore pounds, okay, and his outflow was when he imported goods. So he has to make a payment of 2 crore pounds, and the spot rate was 104.57, and the forward rate is 104.98. Similarly, Japanese yen, this was, his inflow was 1 crore 50 lakhs for all the, exports he has made to Japan. And for imports, his imports here are higher. See, this is only the number where the outflow is higher. In all other categories, we find the inflows are more than the outflows. The Japanese yen, the inflow was 1 crore 50 lakhs and outflow was 2 crore 50 lakhs. The spot rate was 90 paisa and the forward rate is 0.55. So there's a significant shift in the forward rate for Japanese yen. Okay. So determine the net exposure of each foreign currency in terms of rupees. So we have to find out what is the net exposure, okay, of each in terms of rupees, and are any of the exposures positions offsetting to some extent. Okay, just have a look on the question. So in the meantime, I'll just look somebody. So yes, sir, invoicing. Okay, that we have already covered. So this is the question, and you are supposed to answer with respect to 1 and 2, which says determine the net exposure of each foreign currency in terms of rupees. Number 1, are any of the exposures positions offsetting to some extent? Okay, so let's understand. So let's look at this is the answer. Now, the inflow in US term was 4 crores, outflow was 2 crores. The spot rate is given, the forward rate is given. So the additional column is net inflow, which we have added. So inflow minus outflow, 2 crores. So net inflow at the spot rate and net inflow at the forward rate. Now, since the forward rate has gone up from 83 rupees 1 paisa from spot rate to 83.82, so that means it is going to have a net, positive position. Since his inflows are more and the dollar has appreciated, so that means it is going to have a positive impact in terms of his overall positioning. So if he takes a forward cover, then he's going to get a positive impact. French francs, again, the French francs has also appreciated from 13.45 to 14.12, and he has a net inflow which is again positive because his inflows are more, outflows are less. So his net inflow is 1 crore 20 lakhs. Okay, so if we calculate at the spot rate as well as at the forward rate, we find there is a positive impact on his net position because the fact that the forward rate is more than the spot rate. So since he is a net net exporter, okay, on a net basis is an exporter, and the French franc has appreciated, so he's going to get a positive impact on his net position. Similarly, if we talk about UK pound, there also he's a net exporter, and the pound has also appreciated from 104 to 104.57 to 104.98. Okay, so which has also resulted in a positive impact of 41 lakhs to his total overall position. But now come back to the Japanese yen. Here, he is a net importer. His exports are 1 crore 50 lakhs. His imports are 2 crore 50 lakhs. Okay, but the spot rate was 90 paisa. It has become 55 paisa. Okay, so which has actually the foreign currency, the Japanese yen has depreciated. Okay, from 0.9 to 0.55. So Japanese yen has depreciated. Okay, so that means is whatever money he has to pay, it will come down. Okay, he has to pay less. So though the net flow was 1 crore in terms of Japanese yen, and at the spot rate it was 90 lakhs, but in the forward rate it is 55 lakhs. So it is also resulting in a positive impact of 35 lakhs. So that means he was supposed to pay the spot rate of 90 lakhs, but the forward rate is suggesting that it is going up. Rather, the Japanese yen is depreciating, so he has to pay less. So all these factors are having a positive impact. The exposure of Japanese yen position is being offset by a better forward rate. Okay, fine. So this is the Japanese yen, though he is a net importer, but still because the yen has depreciated, so he is having a positive impact. Okay, so this is the question which came in your CA final. So let's talk about now the main question. Okay, this is a wonderful question, so we are going to talk about that. So this is exercise number 9, and I'm going to do this question on the board as well as explain this through my slides. So the question is like this. Following information relates to AKC Limited, which manufactures some parts of an electronics device which are exported to US, Japan, and Europe on 90-day credit terms. So following information relates to a company called AKC, which manufactures some parts of electronics which are exported to USA, Japan, and Europe. So basically, he is an exporter and he gets his payment after 90 days. He is exporting to Japan, USA, and Europe. And if you just see the last line, advise AKC Limited by calculating the average contribution to sales ratio. Just focus on the last line after the box is over. Advised AKC Limited by calculating the average contribution to sales ratio, whether it should hedge its currency risk or not. Okay, so whether it should hedge the foreign currency risk or not. Okay, so this is what the question says. So the information which is given is that the variable cost per unit is 225 rupees. Okay, the goods which is manufacturing and selling abroad, the variable cost is 225 for the goods which is selling to Japan, and USA it is 395, and Europe it is 510. Export sales price per unit. So the selling price is 650 yen. Then USA it is $10.23, and Europe it is euro it is 11.99. So this is his selling price in terms of foreign currency. Now receipts from sale due in 90 days. So this is his sale in terms of foreign currency. So he's selling altogether 78 lakhs of goods, 78 lakhs yen goods to Japan, and to US he's selling $1,02,300. Okay, in terms of dollars. And in euros, he's selling 95,900. This is his sale. Okay, 95,920 euros. Now, the foreign exchange rates information is given below. Now, the rates are first yen versus rupee. Okay, now this is basically, 1 rupee is equal to so many yen, isn't it? Because if you see that, 1 yen is almost like 60 paisa, but if you just have the indirect quote, of in terms of rupee. So 1 rupee will be 2.47. Okay. Got it? So this is basically an indirect quote. 1 rupee is equal to so many yen. But we are going to get the money in yens. So that means we need to either convert this into, in yen code in terms of rupees, because this is in terms of yen. So 1 rupee is equal to so many yen. The quotation is given just exactly opposite. So we need to make a change in that. And we're going to make a reciprocal of bid and ask rates. And we have learned that in our earlier classes. So the spot rate is given. Okay. Fine. The spot rate is of no use because, we have the question says whether we should hedge the currency risk or not. So it is basically the important rates will be 3 months forward rate and 3 months spot rate. So we can just ignore the spot rates because the 3 months forward rate and 3 months spot rate are relevant here. So here the rates of both Japanese currency, USA and Europe. And mind you, all the quotes are given in indirect manner. So it is 1 rupee is equal to so many yen, 1 rupee is equal to so many euros. So it is not like US dollar is equal to what, $80 or whatever. It's not that bad. It's just the opposite. Okay. So it's in the indirect quote. Similarly, rupee is also indirect. Okay. So all this information we have to do is to understand and find out what should be better, hedging or not. Okay. So first I'm going to explain this question and then I'm going to say that even before solving, you can know what he should be doing. Okay. Like just looking at the quotation, but that I reserve to, explain end of the, when I finish this, finishing this answer of this. So let's talk about hedging. So first option is suppose he hedges. Now we know that his sales is 78 lakhs yen when he imports, when he exports to Japan. When he exports to US dollar, the sale is 1,02,300. And his sale is 95,920 euros when he's selling to Europe. Okay. Fine. I think it was Germany. So euro is the currency there. So unit input price. Input price we know it is $650 and if we just go back and it is 10.23, okay, was the price and euro 11.99 was the price of the input. So let's go back in the question. So variable cost per unit and export sales price per unit. Okay, so this is export sales price per unit. So this is your, 650 is the sale price, right? And 10.2 is the sale price. So we can say, this is, I can just make this thing. So this is the sale price. Okay. So I'm just making a small correction here. So it says sale price, unit sale price 650 and this thing. Now, unit sold. So we can arrive at this number. So this number was not given in the question. So what we did was we took, yen 78 lakhs divided by 650. This is the selling price and this is the total money he's going to receive. So this is the total, units sold. So we'll arrive at this number. Okay. So that means he's selling 12,000 units of the goods, which is, exporting to Japan, and 10,000, goods, units sold in dollar terms, and 800 to Germany, 8,000 to Germany. So these are the number of units he is selling. So we have calculated the number of units, how many units he is going to sell in each country or each currency. So because the sale in Japanese terms is given and unit sale price is also given, so we can just simply divide 78 lakh by 650 to arrive at 12,000. Okay. Now the variable cost. Now variable cost is given to you. It is 225 rupees and 395 rupees for US products, and for Euro product this is 510. So what we arrived is we calculated the variable cost by units sold into the variable cost, which is 225 multiplied by 12,000, which comes to 27 lakhs. And then we did was 395 multiplied by 10,000, it comes to 39 lakh 50,000. Similarly, we can take variable cost of 510 and multiplied by 8,000, we get 40 lakh 80,000. So total overall variable cost is 1 crore 7 lakh 30,000. Then we know that these rates are given. 3 months forward rate. Now we are thinking about hedging. So we'll look at the 3 months forward rate first. Okay. So we know that 1 rupee is equal to 2.427. Okay. Let's go back and see the rates there. The rate was given here. 1 yen rate, 3 months forward rate is 2.397. I'm just putting my pointing finger here. 2.397. This was the bid rate and this was the ask rate. Okay. Now he's going to sell. Okay. So the bid rate becomes important here. But since the quotes are in indirect manner, so this will become, the bid rate will become 1 divided by 2.427. Okay. So this will be, now the relevant code would be 1 rupee is equal to 2.47. Okay. And then we'll divide this to calculate. So the total rupee in this thing will be 78. Look at the last this thing, 78 lakhs yen divided by 2.427. Why we are dividing? Because it is an indirect quote and we need a Japanese quote. So either we divide and calculate the direct quote and then multiply, or we can simply divide 78 lakhs with 2.47, which was actually the ask rate. Okay. So when we are, converting into the quote into yen, so this will become the bid rate. Okay. So this is 32 lakhs. Fine. I hope you are understanding. So then we have similarly for US dollars. So US dollars will be 1,02,300 is his selling price, his sale, divided by the quote, which is 1 rupee is equal to so many dollars. So since we have to convert dollars into rupees, so we have to divide. So same thing which we explained for yen. So this was the ask rate, but 1 divided by 0.0216 would become the bid rate. So we take 1,02,300 and divide by 0.0216. So we get 47 lakhs. So similarly, we can calculate for euro. Euro rate was 1 rupee was equal to so many euros. So then we take the same thing, 95,920, and divide it by 0.0178, which is becomes the bid rate. Okay, since he's selling, so the bid rate is applicable. But in the question, we are actually picking up the ask rate and converting them into the bid rate by making the reciprocal of that, because the quotation is given in an indirect quotation. So we need to first convert the indirect quotation to the direct quotation. So we should calculate what is the price of 1 yen is equal to 1 rupee, and then recalculate the bid rate and then divide it. So either we can do that, or simply we can divide the ask rate to calculate the value in terms of rupees. So we have done a indirect method by dividing it. Okay. So then we can calculate the contribution. So we know that this value total receipt in terms of Indian rupees for all the products in Japan, US dollar and euro, we got it. So this is the amount 3247. So then we calculate the contribution. Contribution is nothing but 32 minus 27. So this is the contribution. This is the contribution. This is the contribution for all three products. So overall, the contribution is 26,08,716. Now, this is the sale. This is the contribution. If we divide the sale by contribution by sales, we get 19.56 is the contribution. Okay. So this is when he was hedging. But if we, do the other process where we use, if the risk is not hedged, then what happens? Okay. The first rows up to sale, these things, they all up, with the hedging where we calculated it was 19.56. So it was 19.56 will be the last one. Bottom one, 19.56. So I've kept all the numbers same to this. Okay. This was the hedging option. Now, if the risk is not hedged, in that case, the rupee value of receipts will going to change because we are going to apply the rates. Okay. So rates are given as 2.459. So 78 lakhs divided by 2.5. So we have recalculated how much he's going to get after now we took the spot rates after 3 months. Okay. And not the forward rates. So we calculated what is his receipt, rupee value in receipts. Then we calculated this contribution again. Okay. Now look at the contribution. It has gone down to, and his sale has also gone down. Sale was 1 crore 33 lakhs 38,000. And now at the spot rates after 3 months, the total overall, is coming 1 crore 32 lakhs. Now, how we are calculated? We have taken 78 lakhs divided by 2.45. This is the 3 month spot rate. Okay. And when we divide that, because it's an indirect quote, so we get 31 lakhs 72,000, which has been mentioned here. So just to explain that, how this figure is got. And this figure is coming, 47 is come by taking the same, the value is same in terms of dollars, but the rate is 3 months spot rate. Okay. 3 months forward spot rate is 0.2156. So, which means he's going to get 47. Okay. So all the rupee sales have changed because of the exchange rate. Okay. So his overall, revenue, which was coming to 1 crore, 33 lakhs 38,000 has gone down to 1 crore 32. Okay. Because the rupee, the foreign currencies have actually gone up. They have appreciated overall. Now the contribution has also come down from 26 lakhs to 25 lakhs. So this is the contribution for each product. So we simply add them and again calculate the ratio. It comes to 19.17. Okay. So now when he has hedged himself, his contribution is 19.56. When he has not hedged and, he has not taken a forward cover and he just waited for the spot rates after 3 months. And when he found that his contribution has gone down to 19.17, so which is a better option? Tell me, is it that he should go for a forward cover or he should leave the exposure unhedged? Please answer this question so that we can move, so that I understand you have followed it. Now, just to explain again here, when he uses the forward rate, his contribution sales ratio is 19.56, which is here sales minus variable cost. Okay. So he's getting a contribution divided by sales, which he is earning 19.56% contribution on sales. But if he is not hedged and gets all his money on the spot rates after 3 months, his total overall revenue falls from 1 crore 33 lakhs to 1 crore 32 lakhs. Okay. And his contribution also comes down from 26 lakhs 8,709 to 25 lakhs 45,000, which means that his contribution will be less now. It will be 19.17 as against 19.56. Now, let me know, have you followed first, and whether he should go for hedging or whether he should not go for hedging? So 2 questions. Have you followed? Number 1. Second, should he take a forward cover or should he leave his exposure unhedged? The question is this. So please answer this question. Then we can move forward. I'm just waiting for your responses. So this was a little longish question. So that's why, I kept it on the slides. I can explain some of the things on the board if you want. Okay. So I'm just waiting for your responses, but I know that you will be all responding. But now, just to give you some more perspective, look at this. Now, these are the rates which are given to you. Now, I've got some answers. Risk to be hedged through forward. Prashant Kumar Shukla. Absolutely right. Okay. Now, just, others can answer my question, but I'm just going to explain something which, you will be understanding the whole thing, why what I'm saying. Okay. Now, look at these the quotes. Spot rate, forward rate, and 3 months spot rate. So here, we are not bothered about the spot rate. So what I can do is that I can just, delete the spot rate, which is of no meaning to me. Okay. And just focus on these 2 rates, the 3 months forward rate and 3 months spot rate. Now, the question is that should we go for a forward contract or should we not go? Now, just look at what I'm explaining carefully. Don't miss out what I say. 3 months forward rate is, look at the ask rate here, okay, which will become the bid rate when we actually use it, because this is an indirect quote. So look at the ask rate here, 2.427, 3 months forward rate, and 3 months spot rate, 2.459. So what's happening? The rates are going up. So which means that the rupee is appreciating or the yen is depreciating. So look at the yen rupee quote. We observe that rupee has appreciated more in 3 months spot rate than the forward rate. Or we can say yen has depreciated more in the spot rate after 3 months. So it's one the same thing. So if the rupee has appreciated, that means the yen has depreciated because the quotes are in rupee. Okay. So if the rupee has appreciated, that would mean the yen has depreciated. In such case, the exporter will lose money if he does not hedge his position. Okay. So I'll explain that, Mohammed. Yeah. Now, this is basically, these are the quotes which are given in terms of, yen versus rupee. So look at this. First, I'm going to explain that and then I'm going to answer your question, Mohammed. And I'm going to answer it on the board. Okay. Fine. So now, if you look at this, we find the yen has depreciated. Now, he's getting all his money in yen. If yen has depreciated, more in the spot rates, 3 month spot rate. So he should not be, he should be taking a forward cover. Okay. In such case, the exporter will lose money if he does not hedge his position. Now, but go for the US dollar versus rupees. It is just telling you the opposite. Now, look at this rate. So it was 2.60 and now it is 2.156. So we observe that rupee has depreciated. In this case, rupee has depreciated and dollar has appreciated in 3 months spot rate compared to. In such case, the exporter will be better off if he does not hedge his position. Now, as far as yen and euros are concerned, they're showing a similar trend. Yen also, it has gone up from 178 to 179 as 427 to 459. So both euro and yen are actually depreciating. Okay, fine. So he should take a hedge for both yen and euros. But for US dollar exposure, he should not take. If he has an opportunity, he should not hedge his position for the US dollar because US dollar is actually appreciating and he will get more money and more profit if he does not hedge his position. If he has to make a choice, okay. So if he has to make a choice, but the choice was supposed to be made on the contribution basis, okay. So in example, it was to be done on the basis in CA question, it was based to be done on contribution. So on overall contribution basis, of course, he should go for hedging is a better option. But if you have to single out whether yen, US dollar and euro, we find yen and euro have depreciated, whereas the US dollar has actually appreciated. So if he doesn't hedge his position in terms of US dollar, it will be better. So he should actually, if he has to do a micromanagement, then he should hedge the yen and euro risk and leave the US dollar risk unhedged. So, if you look at this question and in the context of the question, the answer is okay. So advise AKC Limited, if you read the last line, by calculating the average contribution to sales ratio, whether it should hedge its foreign currency risk or not. Okay. So in this case, whether he should cover based on the contribution to sales ratio. So we calculated, just to take you again. So what we did was we calculated his contribution ratio. Okay. Fine. So I'm just going to now explain the point which was mentioned by Mr. Muhammad Abdul Salim. Okay. So I'm just going to rise up on the board and explain that. So please confirm whether you are able to, look at. Okay. So am I visible? My board is, you can see my board and my voice is okay. Just confirm that. So, we are given two rates, 3 months 3 months forward rate. Okay. So this is given, and then we are given 3 months spot rate. Okay. This rate is yen versus rupee. Okay. So let's take one rate first. 2.397, 2.397 and 2.427. Okay. So this is the bid and this is the ask. Okay. 3 months spot rate, similarly. 2.423 and 2.45. Okay, so these rates are given to you. Okay, so this means, if you write it properly, 1 yen is equal to rupees 2.397 and rupees 2.427. Okay, so this is your forward rate. So I'll say forward rate. Okay, so this is the forward rate. And the spot rate after 3 months is also given to you. 1 yen is equal to 2.423. The individual name, please repeat. I'll do that. So rupees 2.459. So these are the quotes which are given to you, isn't it? Now, this is all indirect quotes. So these are all indirect quotes. Because we are going to receive how much? 78 lakh yen. This is what we are going to get. 78 lakh yen. Let me just check that. Here. Now, this is 78 lakh yen. Okay. Sorry, I just made a mistake. So this has been 1 rupee, sorry. So sorry, I just made a mistake here. I'm just going to make a change. This is rupee. This is rupee. This is yen. This is yen. So this is yen. This is yen. So I'm just going to put it properly again. Fine. So these quotes are 1 rupee is equal to 2.397 yen. And this is the bid rate and that's the ask rate. Now we have got 78,000 yen to be received. So the quotation is in terms of rupees. So we need to convert that into yen. So which means 1 yen. So first we are going to convert this forward rate. 1 yen will be 1 divided by 2.427. So this will become rupee. Okay. This will become rupee. And the second one will be rupees 1 divided by 2.397. Okay. So this will come here and this will come here. So this will become bid. This will come ask. Okay. Fine. So 1 yen is this. So we try to solve it. Okay. I use my calculator. 1 divided by 2.4. Of course, I have not divided it in my answer because I just simply multiplied this. Okay. So this is 0.4120. So 1 yen was equal to 0.420. Okay. Fine. This is the bid. And the ask is more relevant because we are using the ask. We are using the bid because, when we are selling goods abroad, we are going to get this price. Okay. Fine. So 1 divided by 2.397, which would mean it will be 0.4171. Okay. So this is in terms of rupees. So this is the rate which is important for us, and this rate is, we can just ignore because this is the rate at which he is going to get his money. So 1 million will be so many rupees. Fine. So let's calculate the spot rate also, and let's see. So it will be like this: 1 divided by 2.459. So we are taking this rate now. Okay, forward rate. So we get rupees 0.4066. So what do you find? In the forward market, when he takes a forward cover, he was getting 41 paisa. When he, if he doesn't hedges himself, he's going to get only 40 paisa. Isn't it? Fine. So which is better, the forward or the unhedged? The forward is better. So this is the better that he should go for the forward rate because there he was getting 1 paisa more. Okay. So the forward rate is better because he will getting better rupees rather than this thing. So if you try to calculate his rupee also, let's see. So if you multiply this by 78 lakh yen, so how much it will come to? 0.4120 into 78 lakhs. So it will come to rupees 32 lakh 13,000. Fine. Rupees 32.13. Now let's talk about here 78 lakhs into 0.4066. So he will be getting only 31 lakhs 71,000. Okay. So if he takes a hedge, he's going to get 32 lakhs 13,000. If he doesn't take a hedge, he's going to get only 31 lakhs. Okay. So let me get back to the question here. So let me just share. So let me see 0.4067. Okay. So let me just put my camera in line. So he was getting 32 lakh 13,000. 32 lakh 13,000. 32 lakh 13,000. And then when he was not, he was getting just to check 31 lakh 72,000. So the calculations are absolute right. Okay, just check. The calculations are absolute right. So I hope you have followed. Clear, Mohammed? Okay. Now coming back to your question with regard to individual hedging. Okay. So forward is better than for yen and euro. Absolutely. Forward is better for yen and euro, but not better for US dollar. Because the US dollar is appreciating, whereas yen and euros are depreciating. So if you are an exporter and you find the currency in which you are exporting is depreciating, that means you're losing money. But if it's appreciating, then you're making money. For example, if $1 is 83 and it goes to 85 and export, you're going to get 85 rupees per dollar when you get your money as against 83. So if the dollar has appreciated against the rupee, you make money. Similarly, if the dollar has appreciated against the rupee, in this case, you're going to make money. So, which means that the forward spot rate is better. Okay, fine, compared to the yen versus euro. Is that clear? So we will have a break now for 15 minutes and come back after some time. Okay. So if you have any queries, please raise your queries on the screen before we break. Anything, or you can raise it and we'll answer it after the break. Okay. So see you after the break. It's 8:30, so 8:45 we will resume our lecture again. Okay. See you. Okay. So students, we are going to resume after the break. So we are going to talk about now external techniques more in detail. Though of course, we have covered some, one question in that, a couple of questions, an example. So let's talk about more about the external techniques. So the external techniques, before we start, is there anything which I can do if you have not followed something? I'll just cover up a little bit later if you have not followed. And but are you understanding what I'm explaining? Is it going properly into your minds? Are you finding the letter okay? So please comment. So coming back to money market hedging. Now, external techniques are of two types, two categories. Okay. Money market hedging and derivative instruments. So basically you can, do it in two ways, either through money market hedging or derivative instruments. Now, derivative instruments are basically nothing but forwards, futures, and options, which we are going to cover maybe today or beginning at the end or maybe tomorrow after the break. Okay, so let's talk about money market hedging. So money market hedging is basically a technique used to lock in the value of foreign currency transaction in the company's domestic currency. So basically you are locking in your transaction in domestic currency and you are hedging yourself. Therefore, money market is hedge which can help basically to eliminate the foreign risk. Okay, so that is the purpose. And for example, suppose a business owner in India expects, rather we should actually go to an example, okay, straight away. So, there are two kinds of money market hedge possible. Both exporters and importers can do it. Okay, so let's talk about, the case where you are an exporter. Okay, and then I'll tell you the logic for all this later on. Okay, so if you are an exporter and your transaction is happening in rupee/dollar, that means you are, exporting goods to in dollars. Okay, so that's the case. So, sir, how you understood rupee appreciated and depreciated medieval hedging that question? Okay, so this will get answered in my subsequent questions, which I'm going to again talk about that. So this is only by looking at the rates. If you look at the rates, the forward rates and the spot rates, and then make out, what is happening. Is it the currency is appreciating? If a currency is appreciating, and if you're an importer, you're going to lose money. But if you're an exporter, you're going to make money. So you can just, after looking at the question, you can know what would be the answer look like, whether you should go for hedge or not. If you're an importer, and if, the dollar versus rupee is the case, if the dollar is appreciating, then, you have to make more payment in the forward market. Okay. And if the spot rate or the expected rate after 3 months or whatever period is less, then you should go for, if it is more than you should go for hedging. So I'll explain when it comes through an example, further examples, rather than explaining it without anything on the board. So let's talk about money market hedge. So Namrata, just I'll answer your questions through examples in my coming slide. So first we talk about money market hedge. Now you can be either an exporter or an importer to use this technique. Now, just to understand, an example through a rupee-dollar case. Now, if you understand rupee-dollar case, then it will be applicable to all kinds of currency pairs. Okay. So, what you'll do, since you are, export, what is happening in export? That the dollar will come to India, isn't it? And then you're going to convert those dollars into rupees, and that will become your realization. So you have to bring the money in India. Okay. So what you're going to do, you're going to first borrow in dollars. So the first step would be to borrow in dollars. That is the foreign currency, because you are exporting the goods to America. So you borrow in foreign currency. Convert the dollar into rupee at the spot rates. You borrow some money in dollars and you bring that. How much you're going to borrow? I'm going to explain that. Convert the dollar into rupee at the spot rates. So you bring the dollars home. Okay. That means whatever you have borrowed abroad, you bring that money and convert that into spot rates. Invest that money so that amount grows. So put that money at the interest rate in India and the amount is going to grow up. Pay the loan Sorry, it's missing. So pay the loan with interest using receivables. So that means you have to, receive money from abroad since you are an exporter. So you are going to borrow money in such a way that the amount of, the money which, you have to repay the loan will be equivalent to the receivables. Okay. So in this way, you are going to, whatever money you are going to receive from your customer abroad in terms of dollar, your loan will get paid out of the borrowings. Okay. And the money will come to India because you are going to convert those dollars into rupee and bring that money home. Okay. And that amount will grow. So this is what we do if you are a exporter. Then if you are an importer, what you do is, now in imports, the money is going to go out. That means you have to make a payment. Now, this is a rupee dollar case. That means you have to make a dollar payment to someone. So what you're going to do, you're going to borrow rupee in home currency, convert the rupee into dollars at spot rates, and invest the dollar so that the amount grows off to pay the US liability. This means that first you borrow the money in India, convert that Indian rupees into dollars, and invest that money in dollars in US so that it grows to the amount what you have to pay abroad. Okay, fine. Then the home currency loan which you have taken in India, plus you have to return the principal as well as the interest. So that will become your total outflow. So when you pay the money in India, the money which you have borrowed in India in terms of rupees, so you have to pay loan, you have to pay the principal as well as the interest. So that will become your cost of imports. So this is very simple. So we can do some question to understand the whole concept. So first of all, let's do this question. Look at this question. An Indian exporting firm, Rohit and Brothers, would be covering itself against the likely depreciation of pound sterling. The following data is given. Okay. Now there's a company called Rohit and Brother. They are exporting goods to England in pound sterling. And if the pound sterling appreciates, they make money. But if the pound sterling depreciates, they're going to lose money. So they would like to hedge their position. Now, receivable of Rohit and Brothers are 5 lakh pounds. So this is the money which they're going to get, after 3 months. And the spot rate of rupee versus, pound is 56. Now it's above 100. So this is again a part of your question paper and study material. Okay. So where the spot rate of pound is given as 56 rupees. Now you're going to get your money after 3 months. Now 3-month interest rate is given. In India, it is 12%. In UK, it is 5%. What should the exporter do? Now you're not given any forward rates or spot rates after 3 months. Nothing is given. Only the interest rates are given in India and UK. Now looking at the interest rate, you know that India, the interest rate is 12%. In UK, it is 5%. So which currency is going to appreciate? The pound or Indian rupee? Please answer this question before we start doing this question. As per the question, the interest rate is 12% in India and UK is 5%. Which currency is going to appreciate after 3 months? And how much approximately annually? Okay. So the rate of interest is 12% in India, UK it is 5%. So which currency is going to appreciate? Is it pound or is it rupees? Pound UK, absolutely fine. No, not Indian UK. It's going to be pound, Mancha, because the rate of interest is 12% in India and in UK it is 5%. So the currency which has a lower rate of interest always appreciates against the country which is having currency which is having a higher rate of interest. So this is which we have done earlier, Mancha. So remember that, like, in USA, the rate of inflation is nowadays 4%, in India it is 6%. We find the US dollar appreciate. Now, yeah, exactly same. Yeah, Namrata, you're right. It will, appreciate by 7%. Yeah, you're right. So for 3 months, it will be 7% divided by 4. So it will be 1.75%. Okay. So remember that approximately 1.75% will be the appreciation in pounds as per what it is given. So we'll check that. When we check the answer, yeah, 56.9 is Shailesh. Absolutely right. So it will be from 56 into say 7%. So it will be uh, 56.98. Okay. So now what we are going to do is, I'm just skipping this first. So as per money market hedge, Rohit and brothers will cover the risk in the money market. So in the absence of any rates given to us, there is no forward rate given. Okay. And nothing, not even the spot rate after 3 months is given. So we can't use the forward cover and compare it with the expected rate going 3 months down the line. So we need to do it through money market hedge. The following steps are required. Borrow pound sterling for 3 months. So you're going to borrow the money in pounds for 3 months and bring this money home. The borrowing must be such that the end of 3 months, the amount becomes 5 lakh pounds. So you should borrow in such a way that when you have to repay the loan, it should exactly become 5 lakh pounds because you're going to receive 5 lakhs from your customer. So that money can be repaid out of this loan. So which means how much you have to borrow? If the rate of interest is 5% in UK, so the borrowing rate is given. So that means you have to borrow 4,93,827 pounds. So what we do is we back calculate. Okay. So 4,93,827 borrowed at 5% will become 5 lakh after 3 months. So that, this will be exactly the same amount which he is going to get from his customer. So the loan can be repaid out of that. Now, the converted borrowed sum into rupees at the spot rate. Now, you have borrowed 4,93,877. You convert that into Indian rupees. The spot rate is 56, which is given in the question. So that means this amount will, be 2 crore 76 lakh 54,000. Then the sum thus obtained is placed in a money market at 12%. After 3 months, it will become 2 crore 76 lakhs 54,000 into 1 plus 12% into 3 by 12 because we are going to calculate for 3 months. So this will become 2 crore 84 lakhs. The sum of 5 lakh pound received from client at the end of 3 months is used to refund the loan taken earlier. So now the money which the company has actually put 4 lakh 93,000 pound, which they have invested in, there. So they have borrowed there. So that money will become 5 lakh pounds. So that means this much of loan they have to pay now. They have actually borrowed 4 lakh 93,827. So which will go to this much. So from now the calculations, the money market operation has resulted in a net gain. How? By 4,83,941. Because 2 crore 84 lakhs is the money, which has been after investment at 12% it has become. And the 5 lakh pound at the spot rate was 56, isn't it? So if we multiply 5 lakh with 56 and minus 2 crore 84, there is a gain of 4 lakh. So that means the 2 crore 84 lakh 83,941 divided by 5 lakh pound, it becomes 56.97 as Salesh Mane has said. So that means you are getting your money at rupees 56.97 rupees. As against 56 because the pound has appreciated. How much? Let's look at it has appreciated by 1.73%. So 56.97 minus 56 divided by 56. And if you just calculate 12% minus 5%, which is 7%, divided by 4, because 3 months, it is 1.5. So you're getting you can check your answer, whether it's right or wrong. So number on this here, basically you have no choice, but actually you are going to use money market hedge because no other information is given regarding the forward rates. Okay, fine. So and now I'm just going to rise up and explain this on the board here. If you can just look here. Okay. So I'm stopping share now and I'm going to get up and explain the question. Okay, fine. So I just open my PPT to understand what is the question. So in this question, what it is given is like this. So basically, you are an Indian exporter. Okay. Your name is Rohit and Brothers. That's the name of the company. And you are going to receive how much? 5 lakh pounds. Okay. And the rate which is given to you, the spot rate. So this is the spot rate, which is rupees 56. Okay. So it means 1 pound is equal to rupees 56. Okay. So this is what is given. This is the spot rate. Now you are going to get money after 3 months. Okay. Fine. So India, the rate of interest is how much? 12%. And in UK, the rate of interest is how much? 5%. So this is given to you. So first, you're going to, do is that you're going to borrow money. The first step is you're going to borrow. Borrow. How much? You have to borrow. I'm just writing the formula here first. 5 lakh pound into, or divide rather. I can just put it like this. 1.1 plus 0.05 divided by 4. Okay. Right. Because this is per annum and for 3 months you have to divide by 4. Okay. So this will become, if you solve it, it will be 5 lakh, the second step, into 1.0125, which will be equal to 493,827. So this will be in pounds. So this much pounds he needs to borrow. Okay, fine. So he's now this what he has borrowed there, he's going to borrow this much of money. Okay, there. Then this money will actually grow to 5 lakhs pound. This will go to 5 lakh pounds after 3 months at the rate of 5%. Okay. Now he is going to get 5 lakh rupees from his customer. So this can be paid from here. So since he has borrowed, the second step would be he has borrowed this money. Now he is going to convert this amount, 4,93,827 into 56 rupees. So he has converted that money. He borrowed the money. He brought that money in India and converted this into Indian rupees. Okay. So this will become rupees 2,76,000, 54,000, 54,300. So this is 2 crore 76 lakhs 54,300. So this will be the amount he will bring. So are you able to see the on board? Okay. So this is the amount which will be converted. So he took a loan of 4,93,827 pound then he used the spot rate to make it into Indian rupees. Now he is going to invest this amount, rupees. The third would be he has got now 2 crore 76 lakhs 54,312. He is going to invest at what rate? At 12% for 3 months. So which will be, which will grow to rupees 2 crore 84 lakhs 83,941. So I'll just write it here again. So it will be 2 crore 84 lakhs 83,941. Okay, fine. So this is the money which has grown now. So that means this is the money which he has got. Okay. Now, if we divide this by 5 lakh pound to see at what rate he's getting the money. So if we calculate, it will come to 56 rupees 97. The spot rate was 56. Okay. This was the spot rate, and this is the rate at which he has got his money by using the money market hedge. Okay. So this is the answer, basically. Okay. So he going to hedge himself, using the money market hedging technique. Okay. Fine. So I'm just going to now just reshare my screen. So is that clear? Is that clear to you all? Now, let me see your questions. The question Namrata was saying, on the basis of information given in question, we have to decide which hedging technique to be used. Now, here, we have not been told, which hedging, whether you should use forward, futures, options, or money market. But in this question, only one information is given, that is the interest rate between the two countries. Okay. And the spot rate. So there is no other option, since no other rate has been given. So we are going to use only money market hedge. Okay. Okay. So I'll just show the question. So this is the question. So the question is, an Indian exporter, I'll just make it a little bit this thing so that we can know. So this is the question. An Indian exporting firm, Rohit and Brothers, would be covering itself against likely depreciation of pound sterling. Of course, Rohit and Brothers felt that the pound will depreciate, but in fact, the rates are suggesting that the pound sterling will actually appreciate. So he may not require any kind of a hedging as such. So falling data is given. But since the forward rates are not given, so we are going to try the hedging technique called money market hedge to understand. Okay, fine. So in this case, we are going to use the money market hedge. So, what I have done is I've done, made a box like this. Borrow pound sterling for 3 months. How much? 4,93,827. The borrowing must be such that at the end of 3 months, the amount becomes 5 lakh pounds. Okay. So, 4,93,000 borrowed at 5% will become 5 lakh pounds. Okay. You can pay the loan with interest using receivables. Now, the second step would be to convert the borrowed money in India at the spot rate of 56. So it becomes this. Then you put this money, it becomes 2 crore 84 lakhs. So which gives you a rate of 56.97 or whatsoever. Okay. So this was the question. So let's move on to the next question. Is it clear? For this question, can we use IRP theory for finding out the forward rate? No, we of course we can find the forward rate, but the forward rate may actually be either more or less or same. We don't know. Normally, the forward rate, if the interest rate differential comes true, okay, and the banks are putting, the interest rate, the forward rates according to the interest rate theory, then of course it makes sense. Sometimes even the rate can be lower and up above. It is not that in reality the interest rate theory will actually always play out. It may have some differences. Okay, fine. So that's why I said there's an arbitrage opportunity when it exists when the rates are not, as same as what the interest rate theory is suggesting. So the rates can be different also. So since the forward rates are not given, so it will not be proper to actually calculate the forward rates unless if you give an assumption that if the interest rate, theory plays out and the forward rates are this, so he's going to make money. Even if we solve by that, but here the question is that you have to solve it through the money market hedge and not by calculating. And you can support that, okay, that you can calculate the forward rate also and check whether the answer, given by the money market hedge and the forward rate which you have calculated through interest rate differential is also the same. Okay, the answer will be same always if you do that. So this is just to recheck. You can calculate the forward rate using the interest parity theory, but that will just, check your answer that what we have done is right or wrong. But if you just calculate the forward rate and give the answer, then you may not get marks. Okay. So now let's do another question. A Limited of UK has imported some chemicals worth $3,64,897. So $3,64,897. Okay, so this is the imports. You have imported some chemicals, A Limited of UK. Now, the person is from UK and he has imported, $3,64,000 worth of chemicals from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot rates and forward rates are given. Spot rate is given and the forward rate is given. And the rates are basically in terms of US dollars, both 6 months as well as spot rate. Okay, fine. So, so that means it is 1 pound is equal to so many dollars. So the rates are basically given in an indirect method. Okay, so we need to convert them into, we have to do the reciprocal to calculate the desired rates. The borrowing rate in UK is 7%. And US it is 6%. So borrowing rates in UK and US are 7 and 6% respectively. And the deposit rates are 5.5% and 4.5% respectively. Now here, remember yesterday, we have assumed that there was only one rate. But now both the rates are given, borrowing rates as well as, deposit rates. Okay. So company has two choices to make. Okay. Company has made two choices to make. Which is, the company has two choices, either to go for a forward cover or to go for money market cover. Which alternative is better? So that is what we need to tell. Okay. So this is the question. So we have to find out which is better. Okay. So, Danisha, so there's a question here. Sir, in nutshell, the person should be borrowed from the foreign at 5% and invest in India at 12% to gain the interest rate benefit of 7% from the arbitrage effect. Because please correct me if I am wrong. So this I'll read. Sir, in nutshell, the person should have borrowed at 5% and invested in India at 12% to gain the interest benefit of 7%. Absolutely right, up to here, from the arbitrage effect. Now, here there is nothing called arbitrage because the forward rate is not given. If the forward rate was given, and if you calculate the forward rate using the interest rate differential and you find there's a difference, then we would say that there's an arbitrage. But since we have not been given any forward rate, so we can't know whether the forward rate and the money market hedge is showing any kind of a different kind of benefits. Okay. So, but absolutely, essence, you have got it right. Is not that what you're saying wrong, but there is no arbitrage effect here because the forward rates are not given to you. Only when the forward rates are given to you, then only you can know whether there is an arbitrage or not. Okay, fine. If the foreign rate was, say, for example, 56, I'll just go back to a screen here so you'll understand that. So that's a very important question. So let me just show you here. So here, you are getting a rate of 56.97, isn't it? Now, suppose the forward rate was, I just add here, I'll add one, box here. Suppose the forward rate was given to you, assuming a forward rate was given to you, and it was rupees 56.75, okay, per dollar, per pound, sorry, per GBP. Okay, so this was given. Okay, suppose the forward rate was given to you. So then your is right that the forward rate is telling you 56.75, but you have got your money at 56.97 by using the money market hedge. Suppose the forward rate was given to you. So which techniques are you going to apply? The forward rate, suppose the forward rate was 56.75, whereas the interest rate differential is giving you a rate of 56.97. Which is better? Go for money market hedge or the forward rate? Just answer me this question. So, Tanisha, what you have raised the question is absolutely right and very important. So, I'm just pondering over here. So, Tanisha, tell me, or anybody, suppose in this question, the forward rate was given to you, which is 56.75. So, would you go for money market hedge or would you go for a forward rate? Now, if you would have gone for the money market hedge because you're getting 56.97, that means you're taking an advantage of arbitrage benefit because there is an arbitrage benefit accruing to you through money market benefit. Okay, so money market hedge will always give you a better chance because if that you are getting a favorable amount here. Okay, fine, which I explained yesterday. So they can be either arbitrage or a reverse arbitrage depending upon forward rate hedge, maybe, sir. No, Tanisha, forward rate hedge is forward rate is 56.75. So that means you will be getting less Indian rupees, isn't it? Suppose you just see that. So if you use 56.75, your actually money in terms of rupee is not going to be good. Okay. So if we calculate this, your money, so it is 5 lakh pounds. Let's take 5 lakh pounds. I'm assuming in the calculator. So I can just invoke a calculator if you can all see that also. So what I'm doing is I'm just putting calculator on the board. Okay. So it is 5 lakh into. Can you see the calculator on the board? I have actually on the calculator. So 5 lakh multiplied by 56.75. So you would have got actually 2 crore 83 lakhs 75,000 rupees. So I'm just putting here. So you could have got, 2 crore 83 lakhs. 2 crore 83 lakhs 75,000. So I'm just going to put the number here. Rupees 2 crore 83 lakhs 75,000. Okay. So if this was the forward rate, then you would have got, 2 crore, right? It's 2 crore 38 lakhs. 2 crore. And it's just correct it here. It is 2 crore 83 lakhs 75,000. 2 crore 83 lakhs 75,000. Now tell me here, by using the forward rate, you would have got 2 crore 83 lakhs. By using the money market hedge, you're getting 2 crore 84 lakh 83,941. Which is better? Tanisha, have you got it? Others, please let me know. Was it the forward cover better or a money market hedge better if the forward rate was given in the question? Please answer it again and why so. I want a little bit better answer now from you. Okay. In the meantime, you could just answer me and I'll move on to the second question also where we are here. I hope you have followed. So please reply. I'm waiting for your reply that, if the rate was 56.75 in the forward market, so which technique was better, money market hedge or forward rate, and why so? Okay. Now come back to this exercise, the new one. Suppose there's a company called A Limited of UK. He has imported chemicals worth 3,64,897. Okay, the amount is payable in 6 months. So this amount needs to be paid after 6 months. The spot rate is given, 6 months forward rate is given. The borrowing rate in UK and US are given. The deposit rates are also given. The company has two choices, forward cover and money market cover. Which alternate is preferable by the company? Okay. Now, this question also was part of your study material, but this had another third option, which is called options. So I've taken it off. When we do the options, I'll add that third choice also, and then we can compare all the choices. But that is for a later date, maybe tomorrow or day after. Money market is better since absolutely. So now let's see. Now A Limited. So this is the same question. So I just put it in different format. Okay, fine. And the company has two choices. Which alternative is better? So let's say now the amount payable is how much? $3,64,897. And 6 months forward rate is given, which is £1 is equal to so many dollars. Now, since it is given in pounds, but we need a dollar rate, so we will do the reciprocal of both the sides, bid and ask, and calculate the dollar rate. And then we will calculate the amount payable in pounds. So 3,64,000 into 0.64704. So we get pound 236. So this is the, if you use a forward cover, will be the outflow in terms of pounds. Okay. So let me just, stand up and do this question on the blackboard so that you can follow it more better. Okay. So let me just, So I'm just going to solve this question on the board also. So you're able to see me on the board. Okay, let me see which color pen I can use. Okay, this is fine. Just let me open the question. So this is basically exercise number 11. Okay, fine. So there is a company called A Limited. This is basically a company which is in UK. Okay, they have imported chemicals. Okay, worth US dollar 3,64,897. Okay. Fine. So this is the company which has imported chemicals amounting to $3,64,897. Okay. The amount is payable in 6 months. So this amount is payable in 6 months. Okay. Now let's look at the forward rates now. The forward rates are given to you. Let's ignore the spot rates at the moment. Let's go to 6 months forward rate straight away to understand how much money is going to pay after 6 months if he takes a forward cover. Okay, 6 month forward cover is, the question is given that £1. Okay, £1 is given equal to dollar 1.5455. Are you able to see the screen? Okay, so this is the rate given, and this is the bid rate, and the ask rate is also given, which is dollar 1.5609. 5609. So these are the rates which are given to you: 1.5455, 1.5609. Okay. Now this is the rate of £1 in terms of dollars, but you are going to actually pay dollars. So we need to convert this into dollar quotation. So we need to, recalculate the rate. So this will be $1 will be equal to, or we can say $1. You can either write here or there. $1 is equal to 1 divided by ask 1.5609. Okay. And then the other rate will become 1 divided by 5455. Okay. So this will be in pounds. Is that okay? Let me just check with it. So this is there. Okay. So $1 is, we bring this here and this here. So this will become bid and this will become ask. Now he's supposed to make a payment, isn't it? So let's first calculate. So this will come to how much? One divided by 1.56009. So this will be pound 0.6406. Okay, fine. And the other one will become pound 0.64704. So let me do that. 1 divided by 1.5455. So 0.647. So we got this. Now, which code is important? This one. This is the ask code. This is for the exporters, and this is for, this rate is applicable for exporters. Do you remember that? Just a trick. This is for importers. So you have imported. So this rate is applicable. So $3 lakh, 3,64,897 multiplied by pound 0.64704 will give you answer in pounds. Okay, fine. So which will be pound 2,36,102. So this will be your answer. If you take a forward cover, that means you have to pay 3,64,000 in dollars, but you are in England. Market cover. So let's understand that. Okay. So let me just share my screen again. So this was the, so we found the answer is 2,36,000 if we use the forward curve. Okay. So this is the forward. Now let's use the money market hedge. Now this is a case of an importer. So that means the money has to flow to US. So he is going to, in case of imports, the money has to flow abroad. So borrow in pounds, borrow in your home currency and invest in US. Okay. Borrow in pounds, that is home currency, and convert the pound into dollar at the spot rates and invest the dollar so that the amount grows to pay off the US liability. Okay. Home currency loan plus the principal becomes your cost of imports. Okay. So this is in nutshell what we have to do. First, we are going to, borrow in pounds. Then we are going to take those pounds to America at the spot rates in terms of dollars and invest that money in dollars. And then the money which grows will be equivalent to your total overall liability which you have to pay abroad. And so that will knock off that. So the money which you have borrowed in pounds, and when you repay along with the interest, will be total your outflow. Now you have to compare that outflow with the forward cover which we have just done and see which one is better. So let's see. So amount payable after 6 months, how much should he deposit in dollars so that he can make the import payment? So that is the first question. Amount payable after 6 months is this much. So deposit rates we know in US are 4.5%. So that means he needs to deposit some money so that it becomes 3,64,000. Okay, first we will do this. So, that means if we take 3,64,897 and divide by, say, 4.5% for, say, 6 months, it will be 1.0225. Okay, so what we have done is that we have applied the formula here. Okay, so fine. So this is 3 lakh. That means the amount will be 3,56,867. So if he deposit this money in US, 3,56,000 for how many? 3 months, isn't it? 6 months. Let's see. 6 months, yeah. So 6 months he has to deposit the money there. And this money is going to become 3,64,000. So he deposits $3,56,867 for 6 months at 4.5%. So this will become 3,64,000. So that he can pay, this amount to his foreign supplier. So that means this much of dollars he should deposit. So fine. So now the question was, he was not supposed to borrow in pounds, but we have seen the other part. So how much he has to borrow in pounds? How much? $356 equivalent to pounds. So that means he has to, borrow. He has to borrow in pound is 2,28,512. So what we have done is that we know how much money he should actually deposit in US. So that money he should have in UK, but it should be in pounds. So the spot rate is given because we are going to use the spot rate here, not the forward rate, because he's going to borrow in pounds immediately. So we use the ask rate here. So we have the 1 pound is equal to so many US dollars. So this is indirect quote. So we will convert the rate into dollars. So $1 will be 0.6379 0.6403. So we'll use the ask rate here, which is 0.6403, because he's going to, convert. He's going to buy, pounds from the dollars what he has. Okay. So, so that means, he's going to convert that. So that means he needs 2,28,512 pounds in US. Suppose he has got now 2,28,500 pounds and he converts this money in dollars, it will become 3,56,867, where he is going to deposit that in America at 4.5%. It will pay off his liability. Okay. So this is, going back and forth, we can find that this is the way we are working. Now we know that the interest for 7 months is pound 7,998. So principal plus interest will be 2,36,000. So let me just complete and then I'll summarize it. So that means the total outflow, if he uses the money market hedge, is 2,36,000. Since he has borrowed the money, how much? He has borrowed 2,28,000. So he has to pay, he will pay it after 6 months along with 7% interest. So 7% interest is this much. So principal plus the interest will become 2 lakh. So that means his total outflow will be 2,36,510. Now we have both these things, forward contract and the money market hedge. Both the things are available. Okay. So the company should take a forward cover to hedge the risk. So the answer will be that you should be taking a forward cover. So I think Shailesh has already pronounced the answer. It's a forward rate is better. Okay. So if you use the forward contract, then the total outflow was 2,36,102 pounds. But when he used the money market hedge, he found that total outflow was 2,36,510 pounds. Okay, fine. So which is better? Have you followed? Should I summarize again? Okay, so let's see. So let's look up at the money market hedge first. So, first of all, here we have to do some back and forth. So, first of all, how much money he has to pay? He has to pay $3,64,897 after 6 months. Okay. Now he is going to deposit some money in US so that it grows to 3,64,000. How much he is going to deposit? 3,56,867. At 4.5%, it will become 3,64,897. So that means this much of money in terms of dollar he should have. From where he is going to have this money? He is going to borrow this money in pounds in England. Okay. So he's going to borrow money. How much? Equivalent to pounds of this money. Okay. So that he can just send that money abroad and invest there. So that it grows to 3,64,000 and he can pay his foreign liability. Now he can borrow at 7%. The question is given that he can borrow at 7%. So now the spot rate in terms of US dollar, that means 1 pound is equal to so many US dollars is given to you. But that is not an appropriate rate. We have to convert them into US rates. Okay. And since he's going to convert, he's going to buy. So, we have to consider the ask rate. So we take the ask rate and multiply. So we get, that means this much pounds he is going to borrow. So we have got now how much he's going to borrow. Okay. This is the amount which he's going to borrow in UK. When he borrows, he has to pay 7% rate of interest. Okay. That is given. So that becomes, the interest liability is this. So principal plus interest becomes 3,36,510. So payable after 6 months will be 2,36,000. So this will be the total outflow in terms of pounds. Now, if we compare both the outflow in money market hedge technique, it was 2,36,510. Forward contract, the outflow was 2,36,000. So company should take a forward cover to hedge the risk. Okay. Now, I just wait for your answers. Have you followed or do you want to understand something which I missed out? So please reply so that I can, otherwise I'll move forward. So we may do 1 or 2 more questions. So I'm just expecting some kind of responses from you. In the meanwhile, I'll just, move on to a little further. So we know that, these are the derivative instruments which we have, forward, futures, options, and swaps. So we have seen some example of forward already. So we will go to futures and options later on. And today we are going to do some more questions on forwards. Okay. And of course, the questions on swaps also we'll be doing. So what is a forward contract? So a forward contract is a customized contract between 2 parties to buy or sell an asset at a specific price on a future date. So we know that a forward contract can be used for hedging or for speculation, although its non-standardized nature makes it particularly apt for hedging. Prashant Kumar Shukla, what is amount meant by equivalent amount? So, he has to borrow money in pounds, isn't it? But then he knows he has to put some money in US dollars so that it grows to the amount what he has to pay in US. So we know that he has to borrow some, $3,26,000. So the equivalent amount would be the amount in the same amount in pound terms, in pound value, because he has to borrow that money in pounds. Okay. So we have done a back calculation to find that how much money he has to borrow in pounds. So let me just go back here to explain. So this is also important. So I think many would be wondering. So how much money he was supposed to pay? $364,897. Okay. Now, in a money market hedge, he needs to deposit some money in America in US dollar terms so that it grows to meet his liability of 3,64,000, which means he has to deposit how much? $3,56,867. So this, if he deposits in a US deposit and he gets 4.5%, this will be exactly meeting his interest, his total liability of 3,64,000. So this much of money he should have with him. From where he'll get this money? He's going to borrow this money from where? In England, in US, in pounds. So now he can't borrow, in England in dollar. So he has to borrow in his home currency. So what we are trying to do is that we are trying to convert this amount into pounds. How much he will be borrowing in pounds actually? So in UK, he's going to borrow in pounds, but it has to be equivalent to 3,56,000 as per the spot rates. Okay. So that means he has to borrow the amount in pounds, which will be 2,28,512 pounds, which is nothing but equal to $3,56,867, which is going to send, to US and invest there. And after, his investment period is over, his amount will become equivalent to his dollar liability. So this was just a kind of a back gear to calculate, how much he has to supposed to borrow in UK. Now, since he has borrowed in UK, so he is going to pay along with the interest. So that means this is the amount which is more relevant to understand how much is his total outflow in terms of pound. So I hope you have understood. Okay, let's move on. Is that okay? Anybody who is not followed that? Prashant, is that clear? Prashant Kumar Shukla. Okay. A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. So it's a customized contract. Okay. A forward contract can be used for hedging or speculation, although its non-standardized nature makes it particularly apt for hedging. So mostly we are using forward contracts for hedging and not for speculation. Okay. India, it is not, you can't do it basically. So a currency forward is a customized written contract between parties that sets a fixed currency exchange rate for a transaction that will occur on a specified future date. So basically, it's a customized written contract between the parties. Okay. So it is Prashant, clear. Wonderful. So it is a customized contract. Okay, fine. The future date for which the currency exchange rate is fixed is usually the date on which the two parties can conclude or buy or sell transaction goods. So the date on which you're going to make the payment, when the payment will actually happen on that base. Okay, so we use the forward rates, and the payment and receipt happens only on the date of the forward rate. A currency forward is a customized written contract between two parties that sets a fixed currency exchange rate for a transaction set for a future rate. It's the same thing. Currency forward contracts are used to hedge foreign currency risk. So they are used for hedging. They are most commonly made between importers and exporters headquarters in different countries. Okay. Okay, Mancha, you will get this servicing, so don't worry about them. Okay. Currency forward contracts are primarily used to hedge against currency exchange risk. So they are primarily used for hedging. It protects the buyer or seller against the unfavorable currency exchange rate occurrences that may arise between when the sale is contracted or when the sale is actually made. So basically, they are hedging tools basically to protect the buyer or seller from unfavorable currency exchange rate occurrences. Okay. However, so this is very important. So please focus here. One most important part. However, parties that enter into a currency forward contract forego the potential benefit of exchange rate changes that may occur in their favor between contracting and closing a transaction. So read this box. Have you understood what it is written? Just read it carefully. And if you have understood, please put on a chat box. What does it mean? However, the parties that enter into a currency forward contract forego the potential benefit of exchange rate. changes that may occur in their favor between contracting and closing transaction. Just to give an example, suppose you are importing. Okay, at the time of import, suppose the rate was 83, and you are going to make the payment say after 3 months, and the 3 month forward rate is say 83.50, 83 rupees 50 paise, isn't it? Now, what happens is if the spot rate after 3 months goes past 83.50, suppose it closes at 85 rupees, then you are happier. Okay, because you are still going to make the payment at 83.50. So let me explain this on a board, okay, so that you can understand this. So let me explain this on a board. Suppose you are an importer. And you are supposed to make a payment of $1 lakh after 6 months. Okay. So this is given to you. And the forward rate is given to you $1 is equal to rupees 83.50. Okay. So the expected spot rate after 6 months. Okay. Suppose there are two cases. Suppose it is 85. Suppose it is 85. So that means you are going to make a payment of 83 lakh 50,000 after 3 months. But suppose if you are not hedged, you're going to make a payment of 85 lakhs. So that means you should take a forward rate contract because the rate has gone to 85. But the second scenario is suppose it has gone to rupees 82. Suppose instead of going to 80, so there are two scenarios. Okay. So this is the first scenario when it was 85. So the second scenario, so this is the first scenario. The second scenario was that it was rupees 82. In that case, if you are not hedging, you would be making a payment of 82 lakhs. Okay. So you should not hedge yourself, isn't it? If the chances of this is going to be more and this is going to be less, you should not hedge. Okay. Now, once you have taken the forward cover, then you don't have to choice. So you have to see that, what is the spot rate after 6 months. If it happens to 85, you are happy. But if you are at 82, you are unhappy because you are overpaying 1,50,000. Isn't it? So that is what the slide says that. Okay. Let me just move back to the slide so that you can understand. Okay, so now look at the last box, which I tried to explain on the board. How about the parties that enter into the currency forward contract forego the potential benefit of exchange rate that may occur in their favor between contracting and closing transaction? So have you got it? So what example what I gave, that if the rate had gone to 82, but you have taken the forward cover at 83.5, so you're not entitled for that benefit. You still have to pay at a higher rate. The spot rate after 6 months went down to 82, so you are actually making a loss on your hedge. So that is what it said. Is that okay? Tell me if you have got it. So forward contracts are not standardized. The terms in relation to contract size, delivery, grade, location, delivery date, credit period are always negotiated. Now, if you're in a futures transaction, doing it through the stock exchange, they are all standardized. But forward contracts are not standardized. The term in relation to contract size, it can be any size, but in futures contract, it has to be in terms of number of lots. Like the lot size in future is $1,000. So it has to be in terms of $1,000. Okay. Suppose if you have an exposure of $1,500, you have to take either one lot or two lot. So they are, standardized in futures. But terms in relation to contract are not standardized. Contract size, you can take any. You can go to the bank and say that I need, $1,500 forward contract. So they will be ready. Of course, these are very small amounts. It has to be in millions. So they'll take it. Delivery, grade. Now, grade. Now, in commodity markets, particularly the grade becomes very important. Suppose you're going to buy a steel of a particular grade, you can mention that in your forward contract. I want this grade of steel. But in futures market, you can't do that because there is only one grade, okay, in commodity markets. Location. Of course, in forward contract, you can say, I need, this commodity of this steel of so-and-so grade delivered to me at, say, Delhi. Okay. So location also you can, always give, particularly in commodity markets in the forward standardized contracts. Delivery date, credit period, all are negotiable. So forward contracts are very customized. They can be tailor-made for your needs, whereas future contracts are standardized. In forward contracts, the buyer of the contract draws its value at the maturity from the delivery term. Okay, so this I'm skipping. So just to give you a last question, to explain you, okay, before we close for the day. Forward contracts are over the counter. Yes, they are over the counter. Mancha, you're right. They are over the counter. That means you go to the bank and delivery grade basically Namrata, delivery grade, have more essence and more importance in commodity exchanges. Okay. When you are, suppose you are ordering certain, products. Okay. Suppose you are a company who requires, like suppose a DLF company like DLF, which is making houses. So they have ordered Tata Steel to supply give us steel. Now, steel is of different kinds, okay? Fine. So you have to specify the grade and, the specifications, everything. So you can do that in a forward contract. But in futures contract, everything is standardized. So you can't, give the grade and anything. So everything is basically standardized. If you go to the commodity markets, it's not very flexible as in case of a forward contract. So for commodities, it's always the forward contracts are always better compared to the futures contract if you have the grade issues and other things, okay? Because that's the thing. Now, examples of the forward contract. Let's take one example and we just close it. Now, this is exactly the same amount. A Limited of India has imported some chemicals worth USD $3,64,897 from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot and forward rates are given to you. Spot rate is given because now he's an importer. He has to make a payment. So the ask rate becomes very important, isn't it? Okay. So the spot rate ask is given. The 6 months forward rate ask is given. 6 months forward rate ask is given. Expected spot rates after 6 months are also given. Okay. Should he hedge his exposure or leave unhedged? Now, I'm just leaving this question to you to answer. So please answer. Tell me. Without even calculations, you can do it, okay? Without even making any calculation, look at the rates. I mean, just forget the spot rate. Look at the 6 months forward rate and expected spot rates. Of course, this is the spot rate what you expect after 6 months as per your company's calculations, and you are getting a contract, forward contract at a certain rate. Now look at the ask rate of the forward. It is 83.27. Look at the expected spot rate after 6 months. It is 83.86. Now tell me which is better. Should you leave it unhedged or should you hedge it? Some people were asking how do we find out which is better by just looking at the rates. So this is a very clear-cut example through which you can just find out whether you should go for hedging or not. That's why I kept it very simple so that you can understand the concept and apply the same to even difficult questions you have in your exam. It is better to forward cover. Yeah, absolutely. It is better forward cover. Should hedge, Prashant. Hedge required because 6 month forward rate is lower than the 6 month. Absolutely, Satish. You have given absolutely the right answer. Others have also given the right answer because you have to look at the rates and compare. If you pay the money at 83.86 per dollar, you're going to make more money. Okay, suppose your expected spot rate happens to be, the actual spot rate, you're going to make more money. Okay, but the forward rate is telling you that you're going to pay at 83.32. So you're, almost gaining what, 54 paisa or something. Okay, hedging is better. Mancha, yeah, absolutely got it. So I think somebody was asking, which is better. Now let me know, how it was the session today. Do you found that you could understand everything? Of course, Mancha, with all the slides will be shared to you. Don't worry about that. So tell me about, have you followed it? Anywhere you have found that it was difficult to understand, or was it easy, or how was the day to day progress? Let me know. How did you find the lecture today? Then we will be moving to um, so this was the answer which I just you know so this was amount payable, so we use this. So okay, I'm just skipping, you all know that what is the answer. Then we'll be moving some more questions later on, tomorrow onwards, or maybe day after tomorrow after the Monday break. So we are going to meet again. So we are going to do some more forward questions, and then we move on to futures, options, and then fate of contracts, and finally the nose through and goes through accounts. Okay. So okay. So today's session very useful, sir. Thanks a lot for sharing your knowledge. Awesome. Everything clear, sir. Wonderful, Prashant. What about you, Mancha? What about Shailesh? Other people? Tanisha? Anyone who's there still there? Okay. So we close the lecture today and see you day after. Thank you so much.